Welcome to the Failure to Innovate, What the Underwriter-Actuary Conflict Teaches Us web seminar hosted by Valin Analytics. I'm Kirsten Marr, Head of Marketing for Valin. We'll begin by introducing our featured speaker. Brett Schroyer is an Actuary and Solutions Architect for Valin Analytics. He identifies practical solutions, identifying opportunities to bring tangible benefits from technical modeling. Brett uses his insurance industry and modeling expertise to bridge the gap that sometimes exists between P&C actuaries and underwriting managers. Brett joined Valin in 2014, bringing a breadth and depth of professional experience in actuarial analysis and financial modeling, earned over his 20-year career as a P&C actuary and insurance professional. Prior to joining Valin, Brett served as Senior Vice President for Reinsurance at Willis Re in Minneapolis. Brett led Willis Re's predictive modeling practice and performed quantitative analysis and actuarial modeling in support of property and casualty reinsurance placements. Prior to this, Brett served in a variety of insurance management roles, including actuarial and underwriting director positions at Travelers and as an actuarial consultant with Deloitte. Brett, I'll turn it over to you.
All right, thanks, Kirsten. I appreciate it. Good morning to you all, and welcome to our webinar today. We're going to talk about the underwriter-actuary conflict, and what it tells us about the pace of innovation in the P&C insurance industry. Before we begin, I have a few words on innovation. Ours is an industry that is not known for being at the bleeding edge of innovation. Change comes to the P&C insurance industry, but it comes slowly. And this is no big secret either. Survey results just recently released this month by KPMG paints a pretty clear picture. Insurance professionals realize that innovation is one of the keys to success, and at the same time, they feel that they don't have the skills that they need to lead that innovation. This should come as no surprise to anybody who's been in the industry for a while. Anyone who's been here several decades know that we have always been, in general, slow to innovate in insurance. To borrow a phrase here from Sir Winston Churchill, I'd say that you can count on the insurance industry to embrace change only when we really don't have any other options to choose from. Well, the world is now changing, and at an accelerated pace. And the insurance industry isn't as insulated as it once was. We're now facing competition from outside. Companies like Google and Facebook are dipping their toes into insurance, as well as competition from within, as a few insurance companies are embracing new methods and new technologies. The same KPMG survey tells us that this competitive pressure is real. It's here, and it's just going to keep ramping up. The choice for us is clear. We have to innovate, or we have to face obsolescence. So in the webinar today, what we're going to talk about is innovation in the P&C insurance space. And we're going to do that through the lens of another survey that we recently conducted that focused on some of the internal conflicts that carriers may be facing. We'll share the details of that survey and discuss what we think this teaches us about how to foster innovation and successfully manage change in the insurance industry. So we'll start with the survey. We asked insurance professionals a very simple question. Are actuaries and underwriters at odds over price? I'll admit that I probably came into this a bit biased, as I am an actuary and I've spent 20 years working in various pricing roles. It's been my personal experience that there's almost always a subtle, or sometimes even not so subtle, conflict between actuaries and underwriters. The surprise here was that more than 3/4 of the professionals that we surveyed identified this concept as well. So now I know it's not just me. This isn't a trivial finding. Right now, pricing is more important than it has ever been before. 30 years ago, carriers could earn a 16% ROE by simply breaking even on the underwriting side with a 100 combined ratio. Now with lower investment yields and lower leverage ratios, carriers are earning 4.5 or 3.5% ROE at their current results. To make profitability targets, carriers have to be making a profit on the underwriting side. They can't rely on the investment side to make up the difference. There's no other option. To make matters even worse, we're now competing in a market where some early adopters have started to become much more sophisticated in their pricing. Companies underwriting and pricing based on traditional methods, like Company B here, the horizontal line, are competing against those early adopters with more sophisticated pricing. Those more sophisticated carriers are able to drive adverse selection by stealing the good risks in green at lower prices, leaving the poor risks behind. Setting prices has traditionally been seen as the domain of the actuary, and we'll talk more about that in a bit. Pricing is just one of the two tools that we have as we work to achieve an underwriting profit. The other is smart risk selection. This is where the art of underwriting comes in. It's knowing whether or not to accept a risk under consideration at the price that's being set by the market. These two tools, pricing and risk selection, are two levers that must be applied in tandem. If you're using them in opposite directions, you're going to go in circles. And this brings us back to our original survey. There's a conflict over price. Over 3/4 of those surveys told us that the actuary and the underwriter are at odds over price. Well, let's look at the why. The number one reason was pretty surprising, at least to me. By a 2-to-1 margin over any other response, people told us that underwriters were simply dismissing the data and the analytics behind the pricing and substituting instead their own judgment. Why is this? In another survey that we conducted earlier in the summer, we asked that question. Why don't underwriters trust data? Here are the top 2 answers from that survey. It's interesting that so many underwriters are actually afraid of predictive analytics. And this is a serious issue, maybe in internal messaging. Companies could be more clear that predictive analytics isn't going to be and can't be a replacement for sound underwriting. For most carriers, predictive analytics is best employed as an underwriting tool, a piece of data that assists the underwriter in pricing and risk selection. Interesting also is the issue of trust there. Underwriters simply not trusting the scores or indications coming out of the models. There are many possible sources of that distrust, and we have some ideas on how you can correct that at the end of the webinar. The other half of the responses were all related to uncertainty. The underwriter and the actuary simply disagreed about the level of the risk. So who's right and who's wrong? Is anybody right? And how can we even be sure? Back to the original survey, not everyone responded that there was a conflict. What's so special about that other 23%? Are they able to somehow better innovate as a result? We certainly see some success stories in the industry. Some carriers are initiating change and they're making waves. These carriers aren't wasting their time on internal conflict. What's their secret? It's really important to understand this right now, given the importance of pricing and where the industry is today. So let's dive into that. Talk a little bit more about underwriting and some ways that the change is already happening there. More than ever before, customers are demanding immediacy, which means underwriters are squeezed for time. They have to generate quotes much faster than they used to. 2 interesting examples we can demonstrate here how much the world has changed in a relatively short period of time. First Comp conducted an in-depth study of response times to closing workers' compensation business. They found that when an insurer provides a quote to an agent within an hour, the quote-to-bind ratio is 52%. But if you wait 24 hours, that drops to 30. Think back 5 to 10 years. Would anyone have talked about a 20% drop in the bind-to-quote ratio because an agent had to wait just 1 business day? Zurich, seeing this trend in customer expectations, cut the time that they had required to give a commercial auto quote from on a 100-vehicle fleet from 8 hours. They cut that down to just 15 minutes. The time savings itself wasn't the only win here. Now, the underwriters can focus on applying their expertise, actually underwriting, instead of spending all of their time gathering and entering data. Both of these examples come from 2012, and a lot has changed over the last 3 years. This isn't the end of the road. This is just the start. From the insurance analyst firm Celent, this graph shows that analytics that is focused on adverse selection and inadequate pricing is bringing analytics to the fore of decision making. It's big news that for the first time in about a decade, investment in analytics is larger than that which is being spent on core system replacements. This means that if your organization is not one of those that are investing in modernizing your underwriting toolkit, you might be falling behind the rest of the industry. What are the consequences of failure to innovate or failure to embrace data in underwriting? We already talked about one possible outcome at the beginning, which was adverse selection. In the case of inflexible prices, somebody who has pricing flexibility and the ability to differentiate can come in and steal the better risks at a lower price, leaving you in the dust. Most companies, though, do have pricing flexibility, so they can take advantage of this flexibility in better aligning price to risk. Having price flexibility without a consistent way to evaluate risk, that's where the danger is here. So here we have an example that we took from one of our recent underwriting workshops. We take two teams of underwriters and we put them in a game where they compete to win new business. Team 1 looked at the loss history, and they found that hazard group 4 was running a 2-year loss ratio about half of any other hazard group. So they developed a strategy to target hazard group 4. They cut rates on hazard group 4, and they won all of that business. Can you guess what happened next? In the subsequent year, hazard group 4 went back to an average loss ratio, but Team 1 wrote all of that business at a discounted rate, so their loss ratio actually increased as a result. A predictive model here could have told them that that was likely to happen, that there was nothing remarkable about hazard group 4 in the entirety. It just happened to have a good 2-year result during that study period. As they say in investing, past performance is no guarantee of future results. One of the more surprising potential consequences of underwriting with incomplete information comes from an observation about market cycles, and I think this is a remarkable story. Willis Re every year does an annual market cycle study, and I'm looking at some work that they did analyzing workers' compensation here. The first graph here is looking at the accident year loss ratios from 1987 to present. And as you can see, there's been some pretty dramatic cycles. This is not going to come as any surprise to anyone who's been in the industry for the last 10, 20 years. We actually expect these market cycles. We find it normal. Heck, we look forward to the market cycle sometimes. But what is surprising is if we overlay on top of this a graph of the pure premiums for that same period. Pure premium is the losses divided by payroll. It's really the amount of losses we expect for an equal amount of exposure over time. The surprising thing here is that that pure premium has been virtually flat since 1995. Losses are not driving the market cycles. If not, then what is? Well, the answer is in the rate. The red line here is an overlay of the rates over the same period of time. And what we see is that the market cycles are being driven 100% by the rates that we're charging. Rates go down, loss ratios go up, and vice versa. It's just that simple. We want to be able to, in a perfect world, we want to underwrite with precision. We want to match price to risk. If we can do that, we can make consistent profits regardless of the risk and regardless of where we are in the market cycle. Leading carriers are deciding where they want to play in the market cycle, not getting pushed around by it. Underwriting with precision is about knowing what you insure. It's knowing the difference in risk between the window washer on the left and the window washer on the right. And sometimes this is accomplished through underwriting expertise. The right underwriter asking the right questions could certainly come up with the differential between these two risks, and it's going to. But sometimes that differentiation is only possible through additional data and more advanced analytics. Well, that's enough picking on the underwriters, or maybe pointing out opportunities for the underwriters. I'm going to switch over to the actuaries now and see some things that the actuaries might consider. Sometimes an actuary would like to think that they have developed the perfect rate plan or the perfect model. And if the underwriter would just follow it, then profits would naturally follow as well. In reality, we find that even the best predictive models are consistently improved when they're used as a component in the underwriting process rather than as a replacement for it. Sometimes you can build a model that actually rivals the power of the underwriter, at least on paper and numerically, but you can almost never beat the combination of an underwriter who is using the model. So for one of our clients, we looked at this very idea. First, let me explain what we call a lift chart, because that's what we're going to be going through over the next few slides. The graph you're looking at right now is a lift chart. This is how we look at the output of a predictive model and gauge its ability to give us accurate and actionable predictions. Imagine you have a model that gives every policy a score from 1 to 10. 1 is the best score possible. We expect these policies to have a very low loss ratio. A 10 is the worst score possible, and we expect these policies to have a very high loss ratio. To measure the power of a model, we look at the actual loss ratio by score. We look for two things. Are the actual loss ratios increasing as we move from left to right? If so, then the model has predictive power. Secondly, we look at what the difference in loss ratio is between bin 1 and bin 10. The larger that differential, the more predictive power the model has. We call that difference lift. So in this example, we started by asking, what predictive power did the underwriters have? And by the way, you can do this at your company. Inside of every underwriter's head is a predictive model. This is what they're trained to do over the course of their career. They look at a risk and they assess the quality of that risk relative to its peers. Is it better than average or is it worse than average? We get to see the underwriter's predictions by looking at what tier they placed a risk in or how much debit or credit they selected for a risk, and we can assign a value to that. That's what we did here. So we look at the green line, which is the underwriter's predictions from 1 to 10. And what we see is that this underwriting organization did a pretty good job in separating the risks from best quality to worst quality. The best risks had a loss ratio about 20% better than average, and the worst risks were 30 to 50% worse than average. That's not bad. Next, we looked at a predictive model. This improved the overall differential between best and worst, so it improved the lift. See, the best risks are now about 50% better than average, and the worst are about 75% worse than average. There's more predictive power here. But finally, we did one simple thing. We took the score from the underwriter and the score from the model. We simply averaged them. This is called an ensemble model. When we did that, that average score outperformed both the underwriter and the predictive model. That's the blue line in this graph. And this is producing, on the best side, risks that are 75% better than average, and on the other end of the scale, about 120% worse than average. This one study is indicative of results that we see all the time. The combination of human expertise and analytics is the winning combination. And it's important to put this information in the hands of underwriters and actuaries so they can understand they're both a part of the final solution. We've had some significant disruptions recently and changes on the actuarial side. Data science, if I look back 20 years ago when I started my actuarial career, I spent most of my time just wrestling data and managing data. And now that's a dedicated job function, and we've gotten much better at managing data as well, so that most companies have a data warehouse. As a consequence, the actuary spends a lot more time analyzing the data and less time wrestling with the data. Predictive analytics, I've harped on this now for about 25 minutes, but this has been a fundamental change to actuarial science as well, in that simple univariate or even multivariate rate making are no longer the state of the art. More advanced rate making techniques are taking the fore, and it's expected for actuaries to know some of these tools and to apply them to their rate making. And finally, ripped from the presses, price optimization is making waves right now, with a number of state insurance departments putting the brakes on this and declaring it illegal or contrary to actuarial principles, saying that, for example, in personal insurance, there's an allegation, there's a loyalty penalty, that the longer you are with your current carrier, the less of a good deal you're going to get at renewal. And it's to your advantage to switch often because carriers are more willing to compete for new business. Well, what impact should that have on pricing, and how are actuaries going to react to that? The point is, disruption happens and will continue to happen. It's our job to handle it gracefully, to adjust, to make changes. Our job is to find ways to innovate. The surprise here if you think back to the first slide about innovation, the surprise is innovation is not impossible. Innovation is necessary. We're not reinventing the wheel and trying to use data and analytics in new ways in the insurance industry. We've got a couple of examples to talk about to illustrate how we've adapted in the past: catastrophe modeling and credit scoring. 100 years ago, as it is today, Lloyd's of London was one of the largest reinsurance marketplaces in the world. Here's a placement slip for coverage on the Titanic. You can see individual names are written and the amount of coverage they're willing to provide. By the way, this is where we get the word underwriter. The people would literally write their name under the coverage. Underwriters at Lloyd's would evaluate and accept risks based on past experience and rules of thumb. Reinsurance for a property portfolio, for example, would be based on past experience for risks in that region and a given limit and attachment point for the ceding company. In the late 1980s, some analysts started doing something novel. They were evaluating losses on a portfolio not based on past events, but on potential future events. They would create a hypothetical hurricane track and run it across a property portfolio. This resulted in a much more sophisticated rate plan, which would be adjusted by location and primary carrier to match that carrier's footprint. The result was the differentiation in price that we saw earlier. These players using that differentiation in price could offer lower rates to lower risk carriers and get some of those risks, leaving the rest behind in an adverse selection scenario. What really turned the tide, though, was Hurricane Andrew in 1992. It was, at the time, the costliest hurricane in U.S. history, with estimates at the time topping out nearly $30 billion. In the aftermath, 11 insurance companies went bankrupt. This one storm dramatically changed the way that reinsurance was handled, with innovation centered in the Bermuda reinsurance market. A broker for Willis Re commented that at the time, reinsurers really started tracking their aggregate exposure for hurricanes after Andrew. Previously, they really didn't have a good handle on it at all. Today, it would be unthinkable to enter into a property reinsurance contract without running the portfolio through at least one catastrophe model. It's not just standard, it's simply a required first step. Switching gears a bit, let's talk about Progressive and look at one of the significant innovations that they made in embracing credit score in personal insurance. At the time, it was definitely not an obvious insight that someone's credit score had anything to do with their loss potential on a homeowner's or auto policy. A common argument at the time was either correlation or causation. Alan Bauer had the support of his organization to lead the adoption of this new technology, which fundamentally changed the face of personal insurance. It didn't stop there, however. He also had a hand in putting personal insurance on the web and selling directly to the customer without an agent in the middle. He was also instrumental in creating many usage-based insurance, or UBI, innovations, also now a mainstay at Progressive and other companies as well. Alan's story is a great one in that it shows how much impact is possible when the right innovator has the backing of a progressive company. These innovations weren't limited to just Progressive. They rapidly spread out into the rest of the personal insurance marketplace as well. There's rapid adoption among all of the largest carriers, and we see a result of that. The top 10 carriers were able to increase the market share from 60% to 80% in the span of just one decade, the start of the internet era. So let's talk more about innovation. What are innovative carriers doing differently? What advantages are they seeing as a result of innovation? Successful carriers innovate for a few reasons, but maybe the most important is so they can better know what they insure. If you can know more about what you insure than your competition, you will win in this marketplace. And when you declare that it's time to innovate, it actually provides an opportunity to bury some of the old conflicts, like the one between the underwriters and the actuaries on price. Coming up, we'll focus on 3 things that these carriers know that make a big difference in their ability to compete more effectively and protect against adverse selection. I'm going to go back to the lift chart for this slide. This is a live example taken from our most recent client. Here you can see, again, 10 bins range 1 to 10, 1 being the best, 10 the worst. The loss ratio range here is from about 40% better than average to about 75% worse than average. And here's the first of 3 things that are making a big difference in carriers' ability to compete. Simply being able to get past the idea of good classes and bad classes. The truth is, regardless of how you cut or segment that data, you're going to have a mix of good and bad risks. Maybe this graph could represent all of the policies with a loss in the last 2 years. We'd normally think of these as bad risks. Nevertheless, I guarantee there's going to be a portion of the book, say 10 or 20%, that's actually very good, even though the segment as a whole has had prior losses. And the reverse is true too. Take your best performing program, and you'll find there's 10 to 20% in there that is really below average and needs attention. You succeed by looking past the general and into the specific account risk evaluation to unlock this key. A second opportunity is knowing what to do once you've identified a bin 1 risk or a bin 10 risk. Having the training, the mindset, the flexibility, the trust to take action on these risks at both ends will give you a tremendous opportunity to compete. Recognizing that your data and analytics is giving you new information and trusting that information enough to take action is where you win here. And finally, there's an opportunity to optimize profitability within a portfolio by focusing on the top 5% or 10% or the bottom 5 or 10%. We conducted a study of our clients' portfolios across multiple lines of business and regions and book sizes. We took all of that data from all of the companies and plotted it here, as you see. What we found was that the best 10% of an insurance company's portfolio, that is the bin 1 business, the stuff on the left, on average, that best 10% accounted for 50% of their total portfolio profit. We then looked at the other side of the scale. What could a carrier accomplish if they could somehow get off of the worst 10%, all those bin 10 accounts? The answer here is that they would increase profits by 60% on average. And finally, we asked the question, how much business should a carrier write to maximize profitability? It's a bit hypothetical, but the answer here is that it happened about the 75th percentile. Carriers could roughly double their profitability if they could eliminate all of the risks in bins 8, 9, and 10. Keep in mind these bin scores are predictions. They're model scores. They're not a measure of past loss ratio performance. These figures directly translate into results a carrier would have achieved if they were optimizing their portfolio size based on model score. So what next? How do you translate any or all of this into action? Well, first of all, I would counsel you, when implementing analytics and underwriting, or anywhere else for that matter, it's important to pick small projects where you can test and learn, where you can involve people in the process from the beginning, and where you can build early on early wins. There shouldn't be a lot of doubt that there are predictive analytics are now table stakes for accurate underwriting and pricing models. The two most important questions are how best to use them and why. We've seen successful carriers focus on 3 areas. 1, skip senior level commitment. Start by defining what specific business challenge you want to solve using data and analytics. Create an alignment on the strategy, the goals, and the metrics to determine what success looks like. Without executive level sponsorship, making meaningful progress can be really tough. 2, make the case to the organization. Outline the process and the business problem you're trying to solve with a simple and compelling story. Your people will support change with a solid roadmap and a clearly defined success metric. It can't be just about numbers and graphs, though. There should be a straightforward narrative that explains why this is important to the organization and why it's important right now. And 3, have transparency through the process and the technology and the model development. That goes a long way to getting an organization to buy in and commit to a project. A predictive model shouldn't be a black box. Explain what data went into the model. Underwriters who can interpret that predictive score are better able to guide discussions with agents, with policyholders, and make more informed decisions. We've seen time and again that carriers who combine transparency with a solid rollout plan have great success without facing a lot of resistance. Working with actuaries in particular, going back to our survey at the beginning, we have to overcome some of their inherently conservative bias. They need to trust that the underwriters are using these new data and analytics correctly and not just using them to push prices lower. In order to trust, though, and I'm an actuary, I know this, they need some way to verify, trust and verify. They need some way to verify it's happening through direct evidence. Fortunately for us, predictive analytics lends itself well to this task, providing a lot of real-time, forward-looking key performance indicators. These are going to open the window to see what's happening on the underwriter's desk today, not 12 months or 18 months down the road when loss ratios start to mature. For underwriters, it looks like the #1 challenge is just getting to trust the data. They need to understand how these new tools and data can be used to sharpen their underwriting craft, not replace it. They need access to real-time reporting as well, so they can see how their use of data and analytics is changing the shape and the profitability of their portfolio over time. Now you might be wondering what a pile of work gloves has to do with overcoming underwriter resistance to analytics. There's a story here that involves work gloves that serves as a great example of how to create a light bulb moment in your organization that can move everyone in the right direction. An executive was trying to get his organization to understand the magnitude of the purchasing problem they had. John Stegner had modeled that they could save the company $1 billion over the next 5 years. That's a big number. But he had a difficult time getting the attention of top management on this issue. They had decentralized purchasing across all their factories when he had a summer intern collect a sample of each glove that they purchased in all the factories. They realized they were purchasing 424 different kinds of gloves. Even worse than that, the price being paid for similar gloves was all over the place. The problem here, of course, was bigger than work gloves, but John believed that keeping it simple to make the point would work better than continuing to show spreadsheets with all of the theoretical savings. So he laid out 424 gloves and all their prices on the corporate boardroom table, and he invited the executives in to take a look. It did the trick. The gloves went on a road show of their own to all the factories, so everyone could see for themselves why they needed to make a different purchasing decisions on a flow. A simple exercise here that brought the point home inside the company and made it easier to get everyone on the same page, bringing a tangible visualization of the problem. We've taken a page from that playbook for our clients. We developed an in-person workshop to help underwriters see firsthand how they can leverage analytical tools in their own decision-making. I talked about this earlier, that underwriting workshop with a Team 1 selected hazard group 4. So we set up a mock competition where teams compete to win business. They use a variety of methods like business rules, past experience, business overlays, predictive analytics, and they compete with one another. It's a really fun and stimulating exercise that also delivers a tangible benefit. It takes the guesswork out of what using predictive models will mean in terms of implications to my work, how it can improve my results, and how it doesn't replace me. We've seen it transform some of the misperceptions around predictive analytics in underwriting teams on many levels. Figuring out ways that you can bring theory into practice and make it hands-on, make it real for your teams, will go a long way to overcoming that resistance to change. So some takeaways for you at the end here. Disruption is real. Everyone's seeing it. Everyone's facing it. Not everyone is reacting in the same way. And history gives us many examples of successful change agents. The internal conflict over price is extremely counterproductive. Particularly in today's investment environment, it's getting in the way of our success. The good news is this conflict is a symptom, not a root cause. It can teach us what we need to be doing if we want to embrace change. We need to trust data. We need to integrate data with decision making. We need to employ real-time measurement for verification. And finally, how do we start? How do we get over the hurdle and start making material change? The answer is to start small, test and learn. It's better to have a good plan today than a great plan next year. Find a finite project, a beachhead project, that's low effort, high probability of success, and work together to make that change starting right now. I want to thank you, all of you, for attending today. And I'd like to take a few minutes. I've gone on for about 40 minutes now. I'd like to take a few minutes or as many as we need to have some questions or Q&A. And Kirsten, have we had any questions submitted yet?
Yes, we do have several questions, and I would like to give everyone just a quick moment to type in any questions that you have, and we'll try to get to all of them here today. I've had a few questions from people asking if we're going to share the slides, the presentation, a recording. Yes, we will send you an email tomorrow that has a link to the recording. Just so you know, also, there will be a link to a short survey there. Because we've had just really an overwhelming response to this whole topic, both from our poll, the number of you that wanted to join this webinar, we are sort of doing a free giveaway just as thanks for attending. Brett was talking a little bit about the underwriter workshop that we do that we think really helps just make this all tangible and helps underwriters understand how this works with their job. So we're going to be giving away up to 3 of those underwriting workshops just as a thank you for attending. If you fill out that short survey when you get to the link to the recording, that's all you have to do to be considered. So with that, let's go ahead and get to questions. So Brett, this question says, based on the statistics referenced, which products or lines of business does this relate to? I would imagine these numbers vary based on large risk versus personal lines, etc.
I'm trying to think of what that might have been the study where we're looking at the best 10%, worst 10%. So I'll answer it a couple ways. One, that study was based upon a number of clients in workers' compensation, commercial auto, and business owners. So it's all commercial lines. In general, I think that there is a lot more opportunity right now in commercial lines for applying predictive analytics or doing these sorts of portfolio optimization because there hasn't been a lot of that done to date. That said, you can build stronger models with lines that have a lot more losses, homeowners and personal auto, which is why predictive analytics started there first. So our approach has been on the commercial line side. We really have the deepest expertise on workers' compensation. We have commercial auto in deployment now. Business owners, we have companies on those models. And I think that those lend themselves well because there is a bit more frequency in having loss data to look at there. Some of the other, if you started going to professional liability, E&O type policies or D&O, that's a lot lower frequency. It'd be tougher to model. Hopefully that answered the question.
Okay, great. So there's a lot of questions coming in. Let me see here. What is the top training an actuary needs to better participate in the evolving insurance market?
I'm fond of the training that's given by the Casualty Actuarial Society. To be honest, it's often a starting point, though. You're not going to attend the rate making and product management seminar and learn everything you need to know about putting together a GLM or a pricing plan. But it's a good focus area to discuss some of the things you're working on, to learn some new ideas. There are, quite honestly, I've gotten a lot of value out of some online courses through Coursera, for example. Stanford has some courses they offer online. There's a lot of online classes in data modeling, predictive analytics, machine learning, data manipulation, new programming languages that can help you just to get a bit of a jump start and get you enough of a solid foundation that you can then start to expand that to more business applications.
So next question, regional players with smaller data sets, what is the minimum size of a data set needed for a predictive analytics exercise to yield meaningful results?
Great question. We like to think of the minimum size in terms of the number of claims that we have to look at rather than the premium volume. As I said, you need the claim data, not just the premium data, to build a credible model. And from that perspective, if we're looking at the last 5 years, and if we have over the past 5 years, I'm trying to remember my rule of thumb now, we like to see at least 1,000 policies. You'd be looking at several thousand claims anyway. The two things to think about there. One is you need a lot fewer claims to look at if you have a different application than a pricing model. It is a completely valid approach to say we're going to build a risk selection model, which just gives us a red, yellow, green. It's an underwriting triage tool. Is this a good risk that we should accept? Is it let's consider it, or a big red X, we don't want to write it? You need a lot less claim data and a lot less policy data to build a 3-bid model than you would to build a 10-bid model. That's the first consideration. The second is, and this is something we do with a lot of our clients, it's not necessary to have your own body of data. There are opportunities to partner with other organizations that have data, or it's possible to use, for example, an industry database that Valen has.
Okay, next question. When you say start small, what exactly do you mean? A single factor, line of business, class of business?
Well, it can be any of those. And it might be that we're thinking about building predictive analytics and we're going to apply it somewhere, and rather than having a complete pricing model that we're going to apply to every one of our policies, we're just going to apply it to renew our new business in one state. We've identified a state that we want to grow in, and if we could apply it to new business in one state, what the effect on
you cut out a little bit.
And apply it to just new business in one state. That's a small risk. It's maybe a small impact. For that one state, it could be a large impact. It's easy to get your hands around, to measure, and to touch. It could also be a pilot or an assessment. Maybe it's not even a live fire, in production exercise, but rather a scenario test. This underwriting workshop that we have is a similar thing. We're using a company's live data and their underwriters, and they get to sit down and they get to second guess what they've done the last couple of years to see if they could have done better, and if so, what does that look like? What kind of work is that, and what's the outcome?
Next question. While working with insurers, who do you primarily see owning the relationship between actuary versus underwriting?
That's all over the board, to be honest. We find that the most successful projects are when the underwriting owns the relationship. And this goes back to some of the mistrust that the underwriters have around the data and more advanced analytics. If it's coming from the actuarial side, or if it's coming from finance or even IT, that's probably the worst possible scenario, is if IT owns the project. Now, neither the actuaries nor the underwriters trust them. If it's coming from being driven by the underwriters, they usually will understand this is a tool that's going to help us. This is a tool that we're going to add to our arsenal, not to replace our expertise. And then it's easier usually to convince the actuaries, because you can rely upon some of the cold hard data that they'll touch, see, and validate.
What work comp premium size is optimal for using the tool?
Yeah, this is probably talking about a policy size, but I'll answer both policy and portfolio. For looking at an individual policy, we want to balance a couple things. If you have $500,000 of premium on a work comp policy, you've got a lot of additional information. In fact, you can be doing individual risk rating on that thing, or a large deductible program, so you've got loss-sensitive premium. You don't necessarily need a 100% accurate model at policy inception. So we find that we don't apply models effectively to those risks. We can give signal, but in fact, the underwriter usually has more information, or the loss-sensitive pricing is more accurate at the end of the day than an initial estimate. The sweet spot, in my opinion, for workers' compensation risk scoring is in the $25,000 to $150,000 range. That's where we're adding the most value. For policies under $25,000, we tend to get a lot of loss-free policies. In fact, most policies are going to be loss-free every year. We've got a separate model that addresses that. But there's a lot to be said for, if it's small and loss-free, it's usually good. If it's small and it has a loss, it usually falls into the bad bucket. So that's number one. Number two is on the size of the portfolio. There is an economy of scale here. If you are under $10 million of workers' compensation premium, but you're a larger company, you might not have enough volume there to justify an investment in predictive analytics. Certainly below $5 million, you just got, you're small. You either need to think about investing in predictive analytics to grow it. Once we get to about 10 or 15, the value's there. We're starting to see a return on those investments of a 5-to-1 or 10-to-1 return. And then, of course, as you get larger, it just gets better.
All right, Brett, last question for today is really going to test your ability to predict the future. So given that we talked about credit score and CAT models as past innovation in insurance, what are some of the next big innovation tools, that you see in the next decade coming to the P&C industry, especially in commercial lines?
I think that we've just begun to touch the tip of the iceberg in the integration of big data into insurance. And I'll take a step back. Big data is defined by the 3 V's, volume, variety, and velocity. So you've got a lot of data, a lot of different kinds of data coming at you very quickly. We have a lot of information that's available. For example, you look at Amazon and tracking orders coming from a company or to a company. What are they spending their money on? Look at their supply chain and how is their supply chain growing or shrinking. Start looking at social media feeds for some of their employees or for their executives, and start seeing what direction their company's moving. What else? You could be looking at their advertising dollars, looking at where they're spending money and how they're attracting customers, and start making guesses about their potential for an E&O or liability lawsuit. We have so many more sources of data and information that right now are kind of taboo. Nobody wants to think that our Twitter feed is one day going to be used to price our auto insurance. But 20 years ago, nobody would have ever thought that your credit history would be used to price your auto insurance. All it takes is a clear indication that this data, which is public information, anybody in the world can see your Twitter feed. A carrier is going to find a way to utilize that, and they're going to find a way to make a difference in pricing personal lines and commercial lines using some of these incredibly wide, diverse, and fast sources of information.
Hey, Brett, we've had a couple more questions come in. So if it's okay with you, why don't we answer those before we wrap up?
Okay.
One is, strongly agree that the best solution is the combination of, underwriter expertise using analytics. But what happens when an underwriter's local knowledge conflicts with predictive analytics? What's the best solution to boost adoption?
That is actually where the magic happens. When the underwriter and the model agree, really the underwriter's not learning anything. They're just getting a reinforcing. Where the underwriter and the model disagree is where that's where the underwriter practices his art or her art and says, why does the model disagree with me, and who's right? And now the underwriter can look at, if assuming the model has transparency, look at why the model's saying what it's saying. And at the end of the day, you might agree with the model and say, yeah, I had never thought of that. Or you might say, I see why you're doing that, but I know something the model doesn't. I know that they've just discontinued an operation, so they'll never have a claim in that line again. And in this way, you're affirming, you're sharpening your underwriting skill by having a consistent and objective baseline to compare against.
And then the last question is, my experience has been one in which underwriters focus exclusively on loss ratio and turned a blind eye to the validity of the data set. 120% loss ratio in a particular class because of small premium volume and one loss. How can actuaries raise the sight lines of underwriters so we see the core drivers of profitability instead of dismissing opportunities on the back of misleading data?
That is a big challenge, and I don't know that there's an easy answer to that. But having a tangible exercise, I'll go back to what I presented, where we look at recasting some results and showing the underwriters that hazard group 4 had an insanely good loss ratio. So let's write the stuff. Well, the next year it didn't. And you can do it the other way around too. Maybe hazard group 2 had 150% loss ratio last year. Well, what's the loss ratio going to be this year? On an intuitive level, I think underwriters need to see that and understand that. We can't necessarily talk to them about credibility theory and whether or not we have enough data to be credible 95% of the time in our prediction. Another thing to go back to, I like to think of there are three sources of uncertainty in insurance that we deal with. One is the quality of the risk coming in the door. Is it a good risk or a bad risk? You know, an agent is sending it to us, or it's coming through our application portal. We have no control over that. The second is what we do with it in terms of risk selection or pricing. And those two things have to go hand in hand, but that's the only thing we have control over. The third source of uncertainty is random, you know, dumb luck or good luck. Was there a loss or was there not? And fully 75%, 85%, whatever it is, of all policies are going to be loss-free in any given year. And the other 15%, you know, they're going to vary over time. So the idea of being able to get at the individual policy level a prediction right on a year-to-year basis is kind of ridiculous. And start expanding that out to 5 policies or 10 or even 100, you're still on shaky ground. That might be a way to support that idea when talking with underwriters.
Great, thank you, Brett. And I want to thank everyone for spending an hour with us this morning. Again, tomorrow we will send out a link to the recording. I had a few people ask for more information about the Underwriter Workshop. Look for that in your email as well. And if you want to talk more about that, just fill out the short survey that we're sending. Thanks again and enjoy your day.
Thank you.